So let's talk about dividend yield on original investment. There's this understanding of cost basis. Cost basis, in my opinion, is just an IRS requirement.
Yep.
It is not necessarily the true value of what you're getting out of an investment, because cost basis changes as dividends get reinvested.
Correct.
So your yield on original investment is totally different than cost basis.
Yeah.
And that's what we're going to kind of unpack a little bit today. And there's also current yield. So you've got current yield, yield on original investment, and cost basis. What in the world do all these things mean? What's the most important?
Right.
As an advisor, I can tell you right now, yield on original investment is like the holy grail of value of a dividend investment, dividend stock.
Well, and I would argue that tells like the true story of how that position, that stock is performing and how it's doing for you and your portfolio.
Yeah. So what is yield on original investment?
So it's taking that exactly what it is. Whatever you initially invested, how many shares you owned at the very beginning, and then putting that against whatever the dividend is being paid out at this current time.
So basically, if I invested $100 and it was paying me $5 when I bought it, and I never put in more than that $100, and now I'm getting paid $10, $12, the yield has changed because it was 5% on that original $100. So I got 5% on $100. That's 5%. Now I'm getting $12. So it's $12 on the original $100. I never gave any more. Now the investment might be worth $200, right? Because you've had it for 10 years, but you never put another dime of your own money in it. It's grown. Now the yield, current yield might be still 5 or 6%,
right? But
the yield on original money is 12%,
right?
Because you just put in $100. And that's where, from a financial advisor, I kind of get a little miffed at times. Because, I'll look at a client and they're like, we'll go over their statement. And they're like, oh, I'm only making 5% on my yield. I'm like, what? You actually only put in this little bit of money over here, 10 years ago. Now you've got all of this dividend in your portfolio right now, and you never gave me another dime. You rolled over your 401k once.
Right.
And we've been,
reinvest.
And now you've got this huge pot of yield of real money. And you have to measure that against what you actually invested, not what your cost basis says.
Or even what the current stock price is. Because occasionally you'll have these stocks, or quite often actually, that really take off, or you give them 10, 15 years and they're significantly higher than where you originally purchased the stock. And that yield, just like you were saying, it may maintain that 5%, or it may even be down at like a 2%.
Yeah.
If you just look at it on the screen, you go to some finance website and it says, hey, X stock is only paying 2% dividend yield. And you're like, what is going on? Yeah. I thought we were trying to target 5 or 6%. And you're like, well, let's take a look at what it really is.
Yeah. You're at 7.5,
and you have 100% growth.
I know. You're playing with the house money at this point. Because we've sold out all the money you put in. This is all profit, and you're getting, X amount of money in dividend income. And this isn't even, we got rid of the money that you've originally invested.
Right.
And we have a couple stocks in our portfolio where I don't think we have hardly any clients that have original money in the position, but they still own more than 100% than what they originally bought.
Which is wild.
And their yield on those investments is probably 5, 6, 7%. And they sold all of it.
Yeah.
Which is crazy.
Deployed and earning money with another stock.
With another stock, which is awesome. All right. So let's give it a very vivid example of what in the world yield on original investment is. So I had some fun with chat, and I'm like, give me a Warren Buffett example. Tell me about, because Warren Buffett is historically one of the greatest investors of all time, but he loves dividends.
Yes, he does.
And I was like,
income.
He loves income. He buys income. And I'm like, give me an example for Warren Buffett of yield on original investment. It pulls up Coca-Cola. He bought Coca-Cola in 1988. He bought 400 million shares. The numbers we're going to talk about here are a little big.
Yeah.
All right. So he put in $1.3 billion into 400 million shares. Now, he was dealing with other people's money. So it's not like, he wrote a check, although he could.
Yeah.
Back then, he couldn't write it.
Right. Yeah. Not in 88.
Yeah. So he put in 1.3 billion, bought 400 million shares of Coca-Cola. At the time, it was $3.25. Now, everybody's out there going, I wish I could have bought it for $3.25. Don't we all? As of last year, the annual yield, the price per share that the dividend was paying for Coca-Cola was $1.84. Okay. Now, if you multiply that times 400 million shares of his original purchase, that's $736 million of dividend income in 1 year.
Which is over half of his
56%.
original investment.
So the yield, and I didn't take the time, I don't think I have it in here. I don't think I took the time to look at what the current yield of Coca-Cola, but it has to be, you're going to look it up?
Yeah.
It's not going to be much. And this is part of the point that we're making, that when he purchased, Coca-Cola, it was hardly paying anything. It was $3 a share. It was probably a few cents of dividend. From 1988 to now, it went from a few cents to a dollar.
Yeah, their yield
$1.84
is 3.15%.
Perfect example. 3%. You got 3.15% dividend yield currently, and yet his yield on original investment is 56%. Every 2 years, he's getting paid back his full investment in dividend income. And some in 2 years. So in a 10-year mark, he's getting 500%. Forget about the value. It's worth way more than $1.3 billion.
$61 and some change right now. So the value's even
that's
crazy.
Insane, because that's what is that? That's 2,000% growth. And then you're getting 56, so you're getting 112% return of original capital every 2 years, and it's up over 2,000% in growth.
But imagine being able to recoup that initial investment every 2 years, and it's going up. Like, they also have a 60-year history of increasing their dividend. So, it's just all pluses with that investment. He just knocked it out of the ballpark.
And you can look across the board in his portfolio, and
Correct.
It's full.
And there's
of positions
several
like this.
I was just looking at one of the people that I follow through social media, who's a dividend investor and growth investor, and his updated numbers for 2024 is there are 146 companies that not only do they pay a dividend for the past 25 years or more, but they've increased that dividend. So there's plenty of companies that are doing very similar
nearly
stuff.
150 companies that have been paying and increasing their dividend for over 25 years. 150.
Yeah.
Okay. A little
so
bit
it's
less.
not like just cherry picking one or two.
He was so brilliant in getting that. Yeah, there's a lot of companies out there that do the exact same thing. Now, they're not always going to work out as good. There are companies that are going to work out even better than Coca-Cola. We didn't cherry pick the best example.
No.
Actually, we can go over other ones like Altria. There's companies out there that will make these numbers look silly. Like, they're so good and so powerful. But what's the point? Why does this matter?
Well, I think first and foremost, his partner, Charlie Munger, he said, it's not really on the buy and the sell that you make money in the stock market. It's on being patient.
Being patient.
So being patient is the key for every investor. It's too often we get caught up in the short term of how a stock is doing and performing in these little snippets. But if you can be patient, we've got other podcasts where we've talked about that at length that you can watch. But basically, given any 15-year time frame in the history of the stock market, and these dividend-paying stocks will outperform just growth-minded stocks over and over again.
Well, the crazy thing is here, in a lot of the podcasts that we've done, we've talked about the snowball effect, the reinvestment.
Yeah.
This isn't even taking that in consideration. This is just the original yield and the dividend times the amount of shares. So you have 400 million shares.
We didn't even add new shares.
We didn't add new shares.
I'm just realizing that, by the way. So imagine if he's been reinvesting.
Which he has been.
Oh, my.
This is just on the original 400. He's been reinvesting those. So his dividend on that is significantly higher.
He's making back probably 100%.
By itself, without reinvestment, this is crazy.
Yeah. I can't even imagine what it would look like if you reinvested.
Yeah, it's silly.
You wouldn't even believe us. We would have to show the guy.
How does this mess with your mind? What does this do as an investor when you understand how this works? How does it affect your your mentality to invest?
I mean, for me personally, even right now, you saw like it's mind blowing. How can this be? I want to learn more, understand it. But I think it's just so counterintuitive to be patient, play the long game. There's nothing flashy about just holding a Coca-Cola stock. Very few articles are getting written about until now.
Correct.
Like I read this an article very similar about some of his holdings about this type of dividend growth. But that's because that's what I research all the time, right? So the normal consumer, normal investor's probably not getting this because it's all about what did this AI stock, how much did it grow this past year?
Like when I think about building a portfolio to handle your retirement, I'm thinking, okay, how all in are you? And I've talked in other podcasts about the word tethering.
Mm-hmm.
And I'm thinking about, okay, if you're in your airplane and the flight that you've been on in that airplane, you've got a parachute. And when you're going to jump out of that airplane, you're going to retire. What are you going to tether to? Are you just going to jump out and be like, I'm going to buy whatever strategy? Or are you going to be like, I'm going to tether myself to buying low and selling high.
Mm-hmm.
I'm going to tether myself to mutual funds, some portfolio manager, ETFs. Am I just going to buy market indexes? Like, what's your strategy? An annuity.
And hope Social Security picks up the slack.
Or if you look at history says you should tether yourself to dividend investments. And you should buy that long before you retire. I mean, look at this one example with Warren Buffett, and he's got countless of them. We're not even focusing on the fact that he made 2,000% growth. We're focusing on the fact that he's making 50%, 56%, which is probably more than that, dividend income in a given year. That is so much. Can you imagine making 50% return of your original investment in a given year?
Yeah.
That's insane. And you can live off of that. You can retire. So if I'm jumping out of my airplane in retirement, I'm like, I got my dividend pension. I got this money coming in. I don't need my portfolio to grow. And if the market goes down, I mean, how many times since 1988 has Coca-Cola lost money in a given year? Like from their stock value?
Yeah.
Probably more than we can count.
Yeah.
And yet their dividend has continually gone up every single year. And he's taken his yield from a few cents to $2, and he's making $736 million a year in dividend income. You take some zeros off of that. I mean, you could be putting in, you could have 700,000, you could have $70,000 of dividend income on one stock,
right?
If you're patient. Because the mindset change here is I'm not investing to just increase the value of my investment. I'm investing to increase the amount of income that I receive on a given year, which requires patience. Which requires you to understand what makes a good dividend stock for why am I attracted to increase my money. And I feel like as an investor, we battle with clients sometimes where they're like, I want my money to grow. I'm like, that's how we get paid. Don't you think we want your money to grow? But I also want to be smart about it, because if there's volatility in the portfolio, you pay me less, but you compound your return because you're buying cheaper with more yield, so that it's like a spring load. It's like there's this contraction, you're compounding, because if it's a good stock, that when things do explode, you leapfrog where you would have been if you would have just consistently grown.
Well, and I think a lot of that conversation of I need my money to grow still comes from the traditional mindset of I have to get this up. I have to get my nest egg up to this value.
So I don't run out.
So that I don't run out, because I know I'm going to have to sell shares and I'm going to be like draining that bucket. Well, our philosophy and how we're trying to help clients is let's never touch the bucket. Let's allow it to produce all of the income that you need, and we can allow that to do whatever it needs to do and whatever the market's going to do.
So let's land this plane real quick. This has been a fun discussion. Any last remarks or comments that you want to make?
No, I think once again, dividend stocks don't have to be boring. There's plenty of options out there. If you're not a big Coke fan, that's fine. But
we're not suggesting Coke.
No, not at all. But there are plenty of companies out there that are doing the exact same thing. I say do your research. Ultimately, be patient and stick it out. Like income is where it's at, that's ultimately what you're looking for.
Buy quality and be
That's it.
patient. Hope you enjoyed this today.